Good morning. Good morning, class.
Good morning, sir.
Good morning. Good morning, class.
Good morning, sir.
Good morning, sir.
Okay. You are welcome to introduction to taxation. So I will start with introduction to taxation this morning. My name is Mr. Tunde Idris. So for some of you, you will have known me for public sector accounting. So I'm also part of the lecturer that will be taking taxation. So for the rest diets, I'm the one that I'm going to take the remaining topic for taxation. So today we are going to start with introduction to taxation. We are going to start with introduction to taxation. So we understand what is taxation, what are the objectives of taxation, so what are the principles of taxation, and so on. So I think the class started by 8 and I've passed the message yesterday for the students. So while we are waiting for the other students, for the rest of the diet, I'm going to talk about introduction to taxation. After that, I will talk about multiple taxation. I'll also talk about stamp duties. So from there, we'll now move to personal income tax. From personal income tax, we'll move to partnership assessment. So from there, we can move to taxation of trustee. After that, we now move to taxation of specialized business. We move to taxation of specialized business. Today, we start. Tax is a compulsory levy imposed by government on the citizen. Tax is a compulsory levy imposed by government on the citizen for the purpose of economic growth and development. A compulsory levy simply means when you are earning an income, so far you are earning an income, you derive an income, that means you are going to pay tax. A compulsory levy means government is the one responsible to collect tax, so that government will use the tax to finance our basic infrastructure needs, like construction of schools, public schools, construction of road, protection of life and properties, provision of basic healthcare center, and so on like that. So in a nutshell, tax is just a compulsory levy imposed by government on its citizens, for economic growth and development. What is taxation? Taxation is a system or method used by government. Taxation is a system or method used by government to collect time to time.
Hello, sir. Your network is breaking.
A system used by government to time, that is collect. Can you hear me clear now?
It's
Hello.
better now.
Okay. Objective of taxation. What is the objective of taxation? Why does government collect tax? Reason why government collect tax. What are the reasons why government collect tax? Objective of taxation. Number one objective of taxation, to generate revenue for government. To generate revenue for what? For government. Government collect tax to generate revenue. One of the major sources of government revenue is tax collection. Revenue from tax is one of the major sources of government revenue. So government collect tax to raise money to meet government expenditure. Government have to pay salary, have to construct road, have to provide health care center, have to provide educations. All these are to be provided with the use of fund. And how can government get fund? Is through tax collection. Another objective of taxation is for redistribution of income and wealth. Redistribution of income and wealth. Government collect tax to redistribute for the purpose of ensuring that there is redistribution of income and wealth. How do we redistribute income and wealth? This one simply means to bridge the gap between the rich and the poor. To bridge the gap between the rich and the poor. To ensure that government collectors to assist the poor or to develop the rural area, so that the rural areas too is going to look in some couple of time, in some couple of years, those local area, those rural area, they will now look like a city. So government bridging the gap between the rich and poor, or redistribution of work, wealth and income, also means government collect tax to do empowerment program to the lower income earner, Government collect tax to also ensure that they pay a living minimum wage. Government collect tax to ensure that they pay a living minimum wage. Another objective of taxation, management of economy. Government, they collect tax to ensure that there is proper management of economy, to manage economy, to pay government debt, to ensure that they regulate economy. We have a stable economy policy. So all these are the reasons why government collect tax. Another reason why government collect tax, objective of taxation, to protect domestic industry. Government, they collect tax to protect domestic industry, local industry. How does this one work? By imposing more tax on foreign company, foreign industry that come and do business in Nigeria. They pay more tax than the local industry. You understand? Local industry or domestic industry, anytime they import good, I'm just giving an example to protect domestic industry. Instead of paying, they will give them some discount on import duty that they will pay as compared to a multinational company or foreign company. So government collects tax to protect domestic industry or local industry, meaning that government impose more tax to foreign company or multinational company, and they give tax incentive, tax discount to local industry. Now, those are the objectives why government collect tax. You may be asked, what are the reasons or objective why government collect tax? To generate revenue, to redistribution of income and wealth, to protect local industry, to manage economy. Another one, to discourage consumption of harmful goods. To discourage what? Consumption of harmful goods. There are some goods that are harmful to our health, like drinking of alcohol, smoking of cigarettes. Government cannot ban these goods, but all these goods, they endanger the life of the citizen. How will government discourage consumption of it? By imposing more tax on such goods, on those goods, they impose more tax on them. Take for instance, if they said the tobacco, they are going to pay a special tax, or the custom duty or excise duty that tobacco company will pay will be higher than any other company. In the long run, the cost of production of cigarettes will increase. When the cost increase, the selling price too will increase. So by the time when people are buying one pack of cigarettes, 4,000, 5,000, so many people will be discouraged from consuming it because the price is increasing. So it will reduce the demand for it, the consumption for it. So many people drinking 5 packets in a day, they will be drinking like 1 packet. So it discourage consumption of harmful good. Harmful good like cigarette, alcohol, tobacco, etc. Government collect tax. They impose more tax on such good so that the rate of consumption will be reduced. Another objective, which is not included here, is to protect foreign exchange rates or to protect, to encourage exportation. Government collect tax to encourage exportation through creation of export processing zone or free trade zone, where most of the companies that manufacture goods for export will be assisted. And anytime they export goods outside the country, when they realize profit from such exportation, that profit will not be subjected to tax. So government, they collect tax. By collecting more tax on imported goods, when we are producing that good in Nigeria, if you are a producer, if you produce the good in Nigeria, you will not pay tax. But if you import the good out into Nigeria, you will pay more tax. Government is doing that to encourage that we are producing locally. We are producing and our exportation increase. Because when we have too much of exportation in the country, we export more. It will have impact on our GDP. Our gross domestic product will grow in the long run. So to encourage exportation or discourage importation is one of the reasons why government collect tax. So those are the objectives or reasons why government collect tax. Now, let's look at Sources of tax law. Sources of tax law. Sources of tax law. What are the sources of tax law? Where do we get tax law? What are the sources of tax law? Where do we get tax law? Number one sources of tax law is the Constitution of 1999. The Constitution of 1999. Some section of the Constitution of 1999 talk about tax. Example, section 3 of the 1999 Constitution talk about different tax that can be collected by each tiers of government. Different taxes and levies that can be collected by each tiers of government. So number one sources of tax law is Constitution. Another sources of tax law, we have statutory law. Statutory law, status. Some people call it status, while in some textbook it's called statutory law. All those law that is passed by the National Assembly, that they are passed into law by the National Assembly, that go through the legislative, by the any law that go through legislative arms is statutory law. Example of those law under taxation is Personal Income Tax Act, Company Income Tax Act, Value Added Tax Act, Capital Gain Tax Act. We have Finance Act. They are all statutory law, because this law, before it is passed into law, National Assembly, they deliberate on it. They make some amendment and they now pass it into the law. So statutory law. Another one is case law. Case law. Case law. Another sources of tax law is called case law. Case law means the sources of tax law that is derived from tax dispute. Tax dispute. Dispute between tax authority and the taxpayer that pass through the court of law. At the end of the day, the judge will make a final judgment on such case. That judgment made by the judges has become a case law. So sometimes the tax authority can take taxpayer to court. However, too, taxpayers too have a right to take tax authority to court. So at the end of the day, one of the party will be the winner. So, and that law, that judgment passed by the judge has become a judiciary precedent. It's now a case law. Example of case law is Shell Petroleum Development Company versus FRS. Shell Petroleum Development Company versus FRS is a case law. Another sources of tax law is budget speech. Budget speech. Budget what? Speech. At the presentation, when the president want to sign budget passed by the National Assembly into law, at the time of signing the budget, president has the power to make some amendments that will generate more revenue to the government at that point. So they can make some speech. That speech it will be implemented immediately, has become a law. Example of such speech, look at the May 29 speech made by our president, our current president, during the inauguration, that such subsidy is gone. It's a speech. It's an inaugural speech. Immediately that the president made that statement that the subsidy is gone, what happened? Most of the fueling stations, they started selling fuel at the high rates. They started selling fuel at the high rate. So we started having a lot of queue in the filling station. Most of the filling stations, they are now holding their fuel. They are expecting the new price. So a tax law too can be made through budget speech, through statement made by the president at the time of signing budgets. We have another one called customary law. Another sources of tax law is customary law. Customary law, those are the law that we derive, a law that relate to tax that we derive from religion or from culture or from tribe. Example of customary law: Islamic law, Christian law, traditional law. Tax is old. Tax has been in existence for over thousands of years. In the Bible, issue relating to tax was stated. Likewise, in the Quran too, issue relating to tax was stated. Even before the two major religions, Christian and Muslim, came to Nigeria, we have the traditional system that we have in Nigeria too. They have been practicing tax. Likewise, in the Southwest, all the traditional leaders, they normally collect tax from the resident of their community. That tax collected by the traditional leader, you can remember, is called the Shakole in the Southwest. We have a Shakole in the Southwest. In the eastern part, we have Osusu. So religions too, Islamic religion, they normally collect zakats. Bible talk about tithes. All these things are part of tax. So customary law is also sources of tax law. So, like I said, we have about 5 sources of tax law. Number 1 is the Constitution of 1999. Number 2 is statutory law. Number 3 is case law. While number 4, budget speech. Number 5 is customary law. Now, let's look at classification of taxation. How do we classify taxation? Classification of taxation. Classification of taxation. How do we classify taxation? Number 1 classification that we have is classification according to tax rates. Classification tax rates. How do we classify tax according to tax rates? Classification according to rates. There are 3 types of tax according to tax rates. We have 3 types of tax according to tax rates. We have progressive tax, we have regressive tax, and we have proportional tax. Like I said, let me repeat again. There are 3 classifications of tax according to tax rates, namely progressive tax, regressive tax, and proportional tax. What is progressive tax? What is regressive tax? What is proportional tax? progressive tax. This is a tax system where the tax rate increases as the income increases. A tax system where the tax rate increases as the income increases. That is called progressive tax. A tax system where the tax rate increases as the income level increases. That is progressive tax. Regressive tax. Let's go on progressive tax. Example of progressive tax: personal income tax. Personal income tax is a progressive tax. How personal income tax is a progressive tax? Presently, the current rate of personal income tax, as your income is going up, the rate of tax is also going up. Example, look at how we compute personal income tax. First 300,000 of your income will be computed at the rate of 7%. While second 300,000, additional 300,000 will be computed at the rate of 11%. Next 500,000 will be computed at the rate of 15%. While next 500,000 will be computed at the rate of 19%. Over 160,000, 1.6 million is going to be computed at the rate of 21%, while above 3.2 million is going to be computed at the rate of 24%. That means personal income tax, that pay as you earn that they deduct from our salary every month, is progressive in nature. Do you understand? It's progressive in nature. What that one means is that as your salary is increasing, your tax rate is increasing. That means somebody earning 200,000 in a month, the tax rate that we are going to use for that person will be higher than somebody earning 50,000 in a month. Somebody earning 1 million in a month, the tax rate we are going to use for the pay for the employee earning 1 million in a month will be higher than the tax rate we use for employee earning 500,000 in a month. That is progressive tax system. A tax system where the income increase, where the tax rate increase as the income level increases, it is a progressive tax system. Another example of progressive tax system: company income tax, according to Finance Act 2020, is progressive now. Company income tax, according to Finance Act 2020, progressive. How? The rate of your company income tax now depends on your turnover. The rate of your company income tax depends on your turnover. If your turnover is ranging from 0 to 25 million, that means your company income tax rate is going to be 0%. But if your turnover range from above 25 million to 100 million, that means your turnover, your company income tax rate is going to be 20%. If your turnover is above 100 million, that means your company income tax rate is 30%. Prior to Finance Act 2020, which is 2019 downward, company income tax rate is proportional, is flat rate of 30% of your profit. But right now, your company income tax rate depends on your turnover. As your turnover is increasing, your company income tax rate is increasing. So under progressive, personal income tax is under progressive. Company income tax is under progressive. According to tax rates, we have talked about progressive. Let's now look at regressive tax system. Regressive tax system. Regressive tax system is a tax system where the tax rate decreases as the income level increases. A tax system where the tax rate decreases as the income level increases. That is regressive tax system. As your income is increasing, your tax rate is reducing. In a nutshell, if you remember under our economics in the secondary schools, in our secondary school, if they want to talk about progressive, they will say it's a system whereby the rich pay more than the poor. The rich pay tax more than the poor. That is progressive. But a system of tax where poor pay more tax than the rich, that is regressive. As the income, regressive tax favor the rich. It does not favor the poor. It favor higher income earner. It does not favor lower income earner. The progressive tax favor lower income earner, does not favor higher income earner. In progressive tax, as your income is increasing, your tax rate is increasing. But in regressive, as your income is increasing, your tax rate is decreasing. Classification according to tax rate. Number 3, classification of tax according to type of tax according to tax rate is proportional tax system. Proportional tax system. What do we understand by proportional tax system? Proportional tax system is a tax system where the tax rate remains the same despite changes in income level. The tax rate remains the same despite changes in income level. That is proportional tax system. The tax rate remains the same despite changes in income level. Either your income increase or your income decrease, you are still going to pay the same rate of tax. Example of proportional tax, value-added tax. Value-added tax is a flat rate of 7.5%. Either your good that you buy is 300,000 or your good that you buy is 5 million, is the same rate you are still going to pay. Your value-added tax still remain 7.5. That is classification of tax according to tax rate. Now, let's now look at classification of tax according to incidence. Classification of tax according to incidence. How do we classify tax according to incidence? Classification of tax according to incidence. There are 2 types of tax according to incidence. We have direct tax and indirect tax. There are 2 classifications of tax according to incidence. We have direct tax and indirect tax. Direct tax, those are the taxes imposed on income. They are the taxes that are imposed on income or they are imposed on profits. Direct tax are the taxes imposed on income or imposed on profits.
Hello. Hello.
Hello, can you hear me?
Yes, sir.
Okay. Direct tax. They are the taxes imposed on income or profits. They are those taxes imposed on income or profits. Example of direct tax. Under direct tax, we have different type of direct tax. We have what? Different type of direct tax. Number one type of direct tax that we have is personal income tax. Personal income tax. Personal income tax is a taxes imposed on income derived by individual, employee, sole proprietorship, partnership, communities. The taxes imposed on income or profit derived by individual, employee, sole proprietorship, partnership, trustees is called personal income tax. Personal income tax is otherwise called pay as you earn, payee. Personal income tax is collected by State Board of Internal Revenue. Personal income tax is collected by who? State Board of Internal Revenue. It's not collected by FRS. Example of State Board of Internal Revenue. LRS. Lagos State Internal Revenue. Me and you, we pay personal income tax. If you are working under paid employment, you are working in a company, every month, the taxes deducted from your salary is personal income tax. If you are a sole trader, you are doing your own business, at the end of the year, the taxes you pay under your business is personal income tax. A professional like me, I'm a professional. I work as a tax consultant. So on my profit or any fees I earn from my rendering of tax services to client, it is due for personal income tax. So personal income tax, they are those taxes imposed on income of individual, sole proprietorship, partnership, trustees, and community. It is otherwise called pay as you earn, and it is collected by State Board of Internal Revenue. Under direct tax, we have different types of tax. Number one of them is personal income tax. Number two, company income tax. Company income tax. Company income tax is a tax imposed on a profit derived by companies. Company income tax is a tax imposed on a profit derived by company. When a company make a profit at the end of the year, that profit, they will pay tax on it. And the kind of tax that they paid on that profit is called company income tax. The kind of tax that they paid on that profit, company income tax. Company that we mean a company registered under Corporate Affairs Commission, either limited company or public limited company. Either LTD or PLC. They paid company income tax. What is the rate of company income tax? Like I said earlier, rate of company income tax according to Finance Act 2020 depends on the turnover. If your turnover ranges from 0 to 25 million, your company, that means you are a small company. Your company income tax rate is 0%. According to Finance Act 2020, a small company that has a turnover less than 25 million in a year, they are not expected to pay company income tax. But if your turnover ranges from over 25 million to 100 million, that means you are a medium enterprise. And medium enterprise, they pay a company income tax rate of 20%. If your turnover is more than 100 million, that means you're a large company. That means you are going to pay 30% company income tax. Now, another type of tax under direct tax is capital gain tax. Another type of tax under direct tax is capital gain tax. Capital gain tax, they are the taxes imposed on gain arising from disposal of chargeable assets. Tax imposed on gain arises from disposal of chargeable assets is capital gain tax. Tax imposed on gain arises from disposal of chargeable assets is capital gain tax. Example of disposal of chargeable assets. When you buy an asset, you buy a motor vehicle. Motor vehicle is an asset. You buy that motor vehicle. At the end of the day, you now make a gain from that disposal of motor vehicle. When you dispose the motor vehicle, you make a gain. You buy the motor vehicle, 3 million. You have used it for 2 years. When you want to sell it after 2 years, you now sell it for 5 million. The difference between the cost of sales proceed and the cost of acquisition of that motor vehicle is capital gain. And such capital gain is going to be subjected to a capital gain tax at the rate of 10%. That capital gain will be subjected to capital gain tax at the rate of 10%. So what that means is that capital gain tax is just a tax imposed on gain arising from disposal of capital assets. Capital asset means land and building, furniture and fitting, motor vehicle, plant and machinery. When you make a gain, assets you have been using, you have used for some number of years. When you now want to sell it, you even sell it more than what you buy it. That means you have made a capital gain and you will pay a capital gain tax of 10%.
Hello, sir. I have a question, sir.
Yes, I can hear you.
Okay, let's say, for instance, maybe
Okay, what is the question?
maybe after you acquired a motor vehicle for 3 million, for instance, and maybe I use it for 2 years, yeah. So let's assume maybe you want to sell it, you were not able to to sell it above the cost of acquisition. Maybe you sold it below, like let me say 2.5 million, and you bought it for 3 million. So will you, in that scenario, would they still charge tax for it?
You will not pay tax from it. You make a capital loss. You have not made a capital gain. When the cost of acquisition is greater than sales proceed, that is capital loss. Capital gain means when sales proceed is greater than cost of acquisition. So you will not pay tax in capital loss. So still under direct tax, another type of direct tax that we have is petroleum profit tax. Another type of direct tax that we have is what? Petroleum profit tax. Petroleum company profit tax is a tax paid by a company engaged in oil prospecting and mining business. That means a tax paid on a profit derived by an upstream petroleum company. Petroleum company or petroleum operation, they divide them into two. They have upstream and what? Downstream. Upstream means company that engage in extraction of crude oil, mining and extraction of crude oil. They are upstream company. Downstream means company that engage in marketing and distribution of refinery products. All those filling stations, they are downstream. Downstream company, they pay company income tax. Why upstream, they pay petroleum profit tax. Petroleum profit tax is now called hydrocarbon tax. It's no more called petroleum profit tax. According to Petroleum Industrial Act, it's now called hydrocarbon tax. So all the upstream like Shell, Chevron, Ajib, Mobil, they are upstream. They are into crude oil. They paid hydrocarbon tax, which is formerly known as petroleum profit tax. But those filling stations that we have, all those filling stations, they paid company income tax. They don't pay petroleum profit tax. Hope you understand. So petroleum profit tax, we don't need it for taxation under skills professional, under skills in ICANN. It is needed in advanced tax for the professional. So another type of tax under direct tax is education tax. Education tax is a tax imposed on a company adjusted profits. Education tax is a tax imposed on a company adjusted profit. It is paid by all companies in Nigeria, and it is imposed on the adjusted profits. According to Finance Act 2023, education tax rate is now 3%. Before Finance Act 2023, education tax is 2.5%. At a time, education tax is 2%. If you look at my table, for year of assessment 2019, 2020, education tax rate is 2%. For year of assessment 2021, 2022, education tax rate, year of assessment 2021 is still 2%. But for year of assessment 2022, 2023, education tax rate is 2.5%. But for year of assessment 2024, 2024 year of assessment, education tax rate is 3%. So this is a mistake. I want to write 2024 under that 3%. Every company paid education tax, limited company, PLC, they paid education tax apart from paying company income tax. And how do we get education tax? Education tax percentage is based on adjusted profit of that company. That means if a company does not make profit, they don't have adjusted profit, they will not pay education tax. But when they have adjusted profit, they will pay education tax. But if they have adjusted loss, they will not pay education tax. Why do we collect education tax? Education tax, who collect education tax? Education tax is collected by FRS. And they collect education tax for the purpose of development of education in Nigeria, for the purpose of recreation of educational development in Nigeria. That education tax collected by FRS, they will remit it to a body called TED Fund. TED Fund means Tertiary Education Trust Fund. Tertiary Education Trust Fund. I'll take my bag. This education tax, they use it to construct classroom, lecture theater, lab room, or any other building in public tertiary institution like university, public polytechnic, public college of education, any college of education or university or polytechnic owned by government, either state or federal government. They are entitled to enjoy TED Fund. Every company paid education tax. Every company, they paid education tax, so far as they have adjusted profits. Do you have any question on this?
So how about private institutions?
So we are still under direct tax. Number one direct tax mentioned is personal income tax. Personal income tax is collected by SRS. Personal income tax is collected by SRS, State Board of Internal Revenue. Personal income tax is collected by SRS, State Board of Internal Revenue. State Board of Internal Revenue collect personal income tax, and it is paid by individual, sole proprietorship, partnership, trustee. Company income tax is paid by company, limited company, PLC, and it is collected by FRS. Petroleum profit tax is paid by upstream petroleum company. It's now known as hydrocarbon tax. It's collected by FRS too. Capital gain tax is paid by both individual and company. That one is at the rate of 10%, but it's paid by both individual and company. Capital gain tax due to company is collected by FRS, but capital gain tax due to individual is collected by State Board of Internal Revenue, e.g. LRS. Education tax is collected by FRS, and it is based on adjusted profit. It is paid by all companies once they have adjusted profit. And the rate currently is at 3% of your adjusted profit. Before, it was 2%. At a time, it was 2.5%. Do you have any question on this? Do you want to ask a question?
Hello, sir.
Yes.
Do private under education tax, do private institutions pay tax too?
Does
Like
private institution pay?
they pay tax like 3% of 3%
No,
rate?
we are saying this education tax. Who enjoyed this education tax? We said public university, public institution. When FRS collect this education tax, they will share it between university, polytechnic, and college of education. They use it to develop public institution. I'm not saying public institution pay it.
Okay.
They enjoy the tax. It is company that pay it. FRS collect it. FRS now remit it to a body called TED Fund. TED Fund, they are now using it to construct buildings in public institution. They don't use it for private institution.
Okay, sir.
Because private institution, private university, they collect school fees. Their school fees is outrageous. Like backward convenant, they cannot enjoy benefit of TED Fund. They cannot enjoy benefit of education tax. Do you understand?
Yes, sir.
Okay. Another type of tax that we should look at is technology tax.
Sorry, sir, I have a question.
Technology tax. Okay, what is your question?
Okay, the personal income tax, is there a particular rate for it, or they just charge it based on the amount of money?
What is your question?
I said the personal income tax, is there a particular rate assigned to it, or it's just based on what an individual is earning?
Personal what?
Hello, can you hear me?
What do you? I can hear
I
you
said,
now.
okay, I said the personal income tax, is there a particular rate for it, or is it charged based on what an individual earns?
Personal income tax rates depends on your income. If your chargeable income is not more than 300,000, the personal income tax rate is 7%. But if your chargeable income is
300 and above.
300 and above, assuming, let me give an example. Assuming your income, your chargeable income in a year, assuming your chargeable income in a year is 700,000, how do I get your personal income tax rate? Personal income tax you are going to pay. Assuming your chargeable income is 700,000, how do I compute your personal income tax? Let me take you back to this table. Under progressive tax, I give you a table of personal income tax. If your chargeable income is 700,000, out of that 700,000, 300 will be taxed at the rate of how many percent?
7%.
7%. It remains how much if you remove 300?
It's remaining 400.
From 700.
It's remaining 400.
Second 300, it remains 400, Abi?
Yes, sir.
Out of 400 remaining, you will now take another 300. That one will be charged at the rate of how many percent?
7%.
Out of 400 remaining, you will take another 300. That one will be charged at the rate of what?
11%.
11%.
11%.
How much remaining?
100,000.
How much remaining?
100,000.
How much is it remaining from your income if you take the second 300,000?
100.
Out of 700. Huh?
100,000.
How much is it going to remain?
400.
100,000. That 100,000 is going to be charged at what rate? That 100,000 fall under
7%.
next 500,000. That 100,000 fall under what? Next 500,000.
Next 500,000.
It fall under this, and it's going to be charged at what rate?
15%.
Oh.
It's going to be charged at what rate?
15%.
15%. Yes, it's going to be charged at 15%. Do you understand? Let me give another scenario. Assuming your chargeable income in a year is 2.6 million. 2.6 million. How do you compute your personal income tax? Your chargeable income is 2.6 million. How do you compute your personal income tax? First, you will remove 300,000. You will remove what? 300 out of that. I say your chargeable income is how much?
2.5 million.
2.5 million. Out of 2.5 million, you first of all remove 300,000. That one will be charged at what rate?
At 7%.
7%. If you remove 300,000, how much is the remainder?
2,200,000.
You will now remove another 300,000. That one will be charged at the rate of
7%.
11%.
11%. Second 300. At the rate of 11%. Out of 2.5, how much have you removed so far?
1.9.
No, how much have you removed so far out of 2.5? You have removed 300,000. You remove another 300,000, making it how much?
600,000.
600. You have removed 600,000 from 2.5. Abi, how much is remaining?
1.9.
1.9.
You remove another 500,000. That one will be charged at what rate?
15%. So our network is breaking now.
15%. It will be charged at the rate of 15%. You will go ahead and remove another 500,000. Okay. That one will be charged.
So your network is not good.
Okay, sorry. 500,000. That one will be charged at the rate of 19%. Can you hear me now?
Yes, sir.
500,000. The next one is going to be charged at the rate of how many percent?
19.
So far, out of 2.5 million, how much have you removed?
I've removed.
How much have you removed?
1.6 million.
1.6 million. How much is it remaining?
900,000.
900,000. That 900,000 is going to be charged at what rate? Who can tell me?
21%.
21%. Because that 900,000 will fall under 1.6. Is going to be charged at the rate of 21%. That is personal income tax. Ladies and gentlemen, your skills, skill exam, personal income tax carry 25 mark. You cannot miss it. You cannot be going for taxation under skill level without knowing personal income tax. 25 mark. So you can see that we have a lot of work to do, and we have not started personal income tax. 25 mark question is coming from personal income tax. So there is no how you can miss it. In most of the cases, they use it as a compulsory. Sometimes they put it 30 mark as a compulsory. So please, I will advise us, we need to buckle our shoe. We need extra class. During the week, if you have any free lecture time, let me know so that I fix lecture for task. Do you understand? So please.
Okay, sir.
So this is how they compute personal income tax. I want to ask a question so that I know whether you understand. An income, a chargeable income that is 1.3, how do we compute this personal income tax? 1.2, or let me use 1.6. How do we compute the personal income? 1 point, let me use 1.7.
1 point what?
1.7. 1.7. Your chargeable income is 1.7.
We use 21%.
Oh yeah, compute the personal income tax. Your chargeable income is 1.7.
Okay. First is still you remove 300,000 naira. Okay, sorry. 1,700,000. I'm putting my calculator.
1.7. How do
Okay.
you compute it?
Okay, first one is you remove 300,000 from it at a rate of 7%. So
Okay.
then minus
Second
300,000.
one.
So the remaining one will be 1.4. So you remove 300 again from inside at the rate of 11% minus 300,000. So it will remain
Okay.
1.1. So we now remove 500,000 from it, from the 1.1 at the rate of 15% minus 500,000.
Okay.
So it remains 600,000.
Okay.
So you remove
You remove another,
The next 500.
the next 500 at the rate of what?
500
At
again.
19%.
It's breaking. 15% minus
19%.
at the rate of
At the rate,
11%.
at the rate of 19%.
Sorry, at the rate
You
of
remove another
19%. Sorry, sir.
at the rate
So
of
it
19%.
yes, yeah. So it will remain 100,000. Yeah. So the other one, it will now be used as in the 21% rate will now be used for 9 points. But the remaining one that's remaining, I think so.
The remaining 100,000 is going to be at what rate?
21%.
21%.
Yeah.
So that is how we compute personal income tax. So that is on personal income tax. The last type of direct tax that we have, that we want to talk about, is technology tax. Technology tax. Technology tax is the last type of direct tax. Technology tax. Technology tax is a tax imposed on a profit before tax of some specified company. Technology tax is not paid by all companies, it's paid by specified company. Example of such specified company that pay technology taxes: telecommunication company, bank, internet service provider, insurance company, pension company. They paid technology tax. Apart from paying company income tax, they will pay education tax. They will also pay what? Technology tax. Technology tax is normally based on 1% of your profit before tax. 1% of what? Profit before tax. And it is imposed on your profit before tax. It is not all companies that pay it. The companies that pay it, they are telecommunication company, financial institution like bank, insurance company also pay it, internet service provider pay it, pension pay it, petroleum companies too. I think they pay technology tax. Technology tax is collected by FRS on behalf of an agency called National Information Technology Development Agency. We call them NIGDA. In some textbook, technology tax is called NITDA. NITDA. N-I-T-D-A. NITDA levy. In some textbook, you see it, NITDA levy. They call it NITDA levy. NITDA levy. NITDA levy. It is imposed. However, for all these companies to pay NITDA, all these companies, specified companies I mentioned, they pay NITDA levy every year. They pay technology tax every year. This technology tax, which is otherwise called NITDA levy, they pay it every year. For this company to pay it, their turnover in a year must more than 100 million. If their turnover in a year is less than 100 million, they will not pay the NITDA levy. If their turnover in a year is less than 100 million, they will not pay the NITDA levy. But if their turnover in a year is more than 100 million, they will pay the NITDA levy. So that is it on NITDA levy. That is under direct tax. Now, classification of tax according to incident. We classify it into two. We said direct tax, indirect tax. Direct tax, we said, is those taxes imposed on income or profit derived by company and individual. And we said direct taxes has different types. Type of direct tax. Number one, personal income tax, company income tax, capital gain tax, petroleum profit tax, education tax, technology tax. Indirect tax is the second classification according to incident. Indirect tax. What is indirect tax? Indirect tax, they are those taxes imposed on goods and services. Imposed on goods and services. And they are the taxes borne by the final consumer. Indirect tax, they are those taxes imposed on goods and services, and they are the taxes borne by the final consumer. It is the final consumer that pay indirect tax. They are imposed on goods and services. They are borne by the final consumer. Example of indirect taxes, or what are the type of indirect taxes we have? Custom duties. Taxes collected by Nigeria Customs Services on imported goods is an indirect taxes. All the custom duties imposed by Nigeria Customs Service on imported goods is an indirect taxes. It is the final consumer, the person that will buy the good, that will use it finally, that will pay it. Indirect tax is a multi-shift tax. It is shifting from one stages of production to another. It is shifted from one stages of production to another. It will shift from the producer to the wholesaler, the wholesaler to the retailer, to the consumer. So number one type of indirect taxes is custom duties. Another one, excise duties. Those goods manufactured internally in Nigeria that they are subjected to some custom duties is called excise duties. So it's an indirect tax. Value added tax, the most common indirect taxes that we have is value added tax. Those goods that they impose on consumption of goods and services. Me and you, we pay value added tax anytime we buy goods and services for our personal use. VAT is already been included in those goods, and the VAT rate is at 7.5%. The VAT rate is at 7.5%. The VAT rate is at 7.5%. So the VAT rate is at 7.5%. So another type of indirect tax that we have is stamp duties. Stamp duties, they are the levies or tax imposed on a document or an instrument so that that document can be a legal binding. Stamp duties, when all those taxes that you paid on some documents, some written document or instrument, that those documents, so that those documents can be a legal binding or presented in the court of law, is called stamp duties. The most common stamp duties is called electronic levy, electronic transfer levy. Those 50 naira charge on our bank transaction that is more than 10,000. Any bank transaction, any transfer that we make to an account that is more than 10,000 naira, we pay the electronic development levy on it. It's an example of stamp duties. So that is that. So that is the type of indirect taxes that we have. I've gave a summary of direct taxes and the category of people that pay the direct taxes and the tax authority that is responsible for collection of such direct taxes and such income that is subjected to direct tax. I gave the summary of it in this my lecture notes. Example, personal income tax, salaries, employment income are example of such income subjected to personal income tax. Interest earned by individual is subjected to personal income tax. Who are the people that pay personal income tax? Persons liable, individual, employee, sole trader, partnership, trustee, estate. What is the law regulating personal income tax? We have personal income tax at 1993. Who are the administrative body for personal income tax? Who are the administrative body for personal income tax? State Board of Internal Revenue Service. So I gave the example. Now, let's look at principles of taxation. Principles of taxation. What are the principles of taxation that we have? Principles of taxation. Principles of taxation is otherwise called canon of taxation. Canon means C-A-N-O-N. Canon of taxation. That is the attribute of a good tax system. Canon of taxation. Principles of taxation is otherwise called canon of taxation. What are the canon of taxation? Number one, principles of taxation that we have. Principles of convenience. Principles of convenience. Principles of convenience. Principles of convenience simply means A good tax system should be convenient to the taxpayer. Convenience simply means the method of payment of tax, the method of collection of tax should be convenient to the taxpayer. The method and time for collecting tax should be convenient to the taxpayer. How? Example of principles of convenience is FRS of recent in 3 years ago, they introduced a technology to make tax collection convenient to the taxpayer and tax filing convenient for them. They introduced a technology, a software. That software is called what? Who can help me with that software? What is the name of the software?
Tax Pro Max.
Tax Pro Max. In order to ensure that the tax system is convenient to the tax authority and the taxpayer, they introduced Tax Pro Max. In Tax Pro Max, you can file your tax return conveniently. You can file your tax return conveniently. As I'm talking to you now, if I want to file tax return for any of my clients using Tax Pro Max, I can file it conveniently through my laptop. I don't need to go to tax office. I don't need to go and be filling a form. I will just log into the Tax Pro Max profile of the company I want to file the tax return and enter the relevant information. Right now, as I'm talking to you, if I want to pay for any tax, I can pay it through Tax Pro Max. I don't need that. I don't need to go to bank. I don't need to say, bank does not open today, I cannot pay tax. Before, tax is not convenient to the taxpayer. Taxpayer, they have to spend money to go to tax office, to go and pay tax. Spend transport money. They have to print documents, cost of printing. They have to go to bank and waste time in bank to pay for tax. Sometimes bank will even said, madam, you want to pay for tax. You know what you do? Come back the next day. Network is not good today. Have you not experienced that?
Yeah.
So a good tax system should be convenient to taxpayer. That means method of the tax payment and time of the tax payment should be convenient to the taxpayer. Another principles of taxation that we should look at principles of simplicity. Principles of simplicity. What does this principle is saying? A good tax system should not be complex or ambiguous. A tax system should be written in a clean and understand language. This implies that a tax system should not be complex, should not be written in a language that is not understood by the taxpayer. So that taxpayer cannot be claiming that is ignorance of tax law. No. Principles of simplicity simply means a tax system, a good tax system should be written in a language well understood by taxpayer. It should not be too complex. The English that we should use for a tax reporting process or tax policy should be a simple English. It should not be the complex English that if taxpayer want to interpret it, he will not go and carry the dictionary. No. This one also means, simplicity also means tax should be written in a language understood by taxpayer. This simplicity, this principle of simplicity is directly addressed to the tax authority that tax authority, anytime you want to publish any notice in tax, publish it in the language understand by the taxpayer. If you are in tax practice, if you study FRS very well, if FRS want to make any publication about recent development in tax system, they will publish that publication in English language. They will publish it in Yoruba language. They will publish it in Hausa language. They will publish it in Igbo language. So that some people that are paying tax, they don't understand English, but they are paying tax. They may understand Yoruba. So that they will not be claiming in the court law that, since I don't understand English, you publish it in the English. So that they will not be claiming ignorance of tax law. That is principles of simplicity. Another principle, principles of economy. Principles of economy or principles of economic efficiency. Principles of economy. What does principles of economy is saying? This one is saying that a tax system, this one also addressed to tax authority. A tax system should be based on cost-benefit analysis. That means the benefits derived from tax should be more than the benefit derived from tax collection by government should be more than the cost used by government in collecting the tax. The cost of administering a tax should not be more than the revenue, the actual revenue realized from the tax. The cost of tax administration should not be more than the actual revenue realized from such tax. So government should collect more revenue than the cost that they incur in the process of tax collection. Another principle, principles of equity. Principles of equity. This one, that system should treat taxpayer in an equal manner, unbiased or fairness way. Unbiased or fairness way. Based on their religion, based on let's treat taxpayer. Those taxpayer is to pay low tax. I say because it's going to be higher. Treat them only.
No, sir, your network is breaking.
My network is
It's breaking, sir.
can you hear me?
No, it's breaking, sir.
Okay, let me log out. Hello? Hello?
Hello, sir.
Can you hear me? Can you hear
It's a
me?
bit, it's a bit better.
Oh, please. Principles of equity. Principles of equity. What does principles of equity is saying? We should treat the taxpayer equal. Taxpayer should be treated equal. There should not be unbiased treatment of the taxpayer. Treat them equally. Fairness. Another principle. Principles of certainty. This one said, this principle state that a good tax system should state the amount of tax to be paid clearly. Certainty means the method used by the tax authority in calculating the tax due to the taxpayer should be clearly understood by the taxpayer. Certainty. Tax should not be something that is rigid, that they will just tell you pay this tax. They should tell the taxpayer how they arrive at the amount of tax that the taxpayer want to pay. The method used to calculate the tax due to the taxpayer should be clear and understood by the taxpayer. Tax system should not be rigid. That is certainty. Principles of flexibility. This one is saying that a good tax system should change based on changes in circumstances of the country. Tax system should change based on changes in circumstances of the country. What that means is that as sometimes the economy will boom, there will be more money in circulation. At that time, government can increase tax. But sometimes the economy will be so harsh that people will find it difficult to earn income. At that time, government should reduce tax. Flexibility. Tax should not be rigid. It should not be static. It should change based on circumstances in the country. Sometimes government will increase tax rate because there is too much money in the circulation. Sometimes government should reduce tax rate because there is no much money in the circulation. That is what this principle is saying. So we have principles of flexibility. So if we are asked what are the principles of taxation, we have principles of conveniency, principles of certainty, principles of equity, principles of flexibility, principles of simplicity, principles of economy. So all these are the principles of taxation. Now, let's look at tripartite of tax system. Tax system we are talking about. What are the tripartites of tax system? Tax system have three tripartites. Element of tax system. We have three elements of tax system. We have three elements of tax system. Number one element of tax system that we have is called tax policy. Number two, tax law. Number three, tax administration. Element of tax system is called tripartite of tax system. And there are three elements of tax system: tax policy, tax law, and tax administration. What is tax policy? Tax policy means a general statement or guideline published by the tax administration to give direction on how tax should be collected. General statement or guideline published by tax authority to give guideline or direction on how tax will be administered is called tax policy. In Nigeria, we have a tax policy called National Tax Policy. It's a set of guidelines, principles, rules that regulate Nigeria tax system. National tax policy is a set of guidelines, rules, regulation, principles that regulate Nigeria tax system. What are the objectives of national tax policy? Objective of national tax policy: to guide the operation and review of Nigeria tax system. To guide the operation and review of Nigeria tax system. Number two objective of national tax policy: to provide guidelines for the review of Nigeria tax system. Number three, to provide the basis for future tax legislation and administration. To provide the basis for future tax administration and legislation. Another objective of national tax policy is to serve as a point of reference for all stakeholders on taxation. To serve as a point of reference for all stakeholders in taxation. Another objective: to provide benchmark on which stakeholder shall be held accountable. To provide benchmark on which stakeholder shall be held accountable. That is national objective of national tax policy. You know, I said tax system have three tripartite or three elements: tax policy, tax law, and tax administration. We have talked about tax policy, and we said the tax policy that we use in Nigeria is called national tax policy, and we look at the objective of that national tax policy. Tax law. What are the tax law that we have in Nigeria? We have personal income tax law 2004, company income tax law 2004, petroleum profit tax law, petroleum profit tax act law, capital gain tax act 2004, value added tax act 2004, education tax act, stamp duty tax act. All these are the tax law that we have in Nigeria. Tax administration. Who are the tax administration? Tax administration, they are the body charged with the responsibility for collection and administration of tax in Nigeria. The body charged with the responsibility for collection and administration of tax in Nigeria. Those bodies charged with the responsibility of collection and administration of tax in Nigeria. They are the tax administration. They're charged with the body responsibility of collection, administer, and regulation of tax in Nigeria. Each tiers of government have their own tax administration. Federal government has their own tax administration. Who is the tax administration of federal government? Give me example of tax administration of federal government.
FIRS.
FRS, correct. Nigeria Customs Service too. They are tax administration of federal government. State government. Who are the tax administration of state government? State Internal Revenue Service. For the local government, who are the tax administration of local government? Local Government Revenue Committee. Local Government Revenue Committee. They are the tax administration of local government. Now, under the tax administration, let's look at different taxes or levies collected by each tiers of government. What are the different taxes or levies collected by each tiers of government? Number one, federal government. What are the taxes collected by federal government? Federal government collect company income tax. They collect petroleum profit tax, which is known as hydrocarbon tax. They collect education tax. They collect value added tax. They collect capital gain tax on corporate or non-resident individual. They also collect stamp duty on corporate body. Aside that, federal government collect custom duties. They collect excise duties. They collect royalty on crude oil. These are the taxes collected by federal government. What are the taxes collected by state government? State government collect personal income tax. They collect stamp duties on individual. They collect capital gain tax for individual. They collect withholding tax for individual. They collect business premises. State government also collect development levy. State government also collect market levy. State government also collect consumption tax. State government also collects entertainment tax. So these are the taxes collected by state governments. What are the taxes collected by local government? What are the taxes collected by local government? Local government, they collect tenement rates. They collect shop and kiosk rates. They collect marriage, birth, and death certificates fee. They collect naming of streets. They collect motor vehicle license. They collect television license. All these are the taxes collected by local government. What are the taxes collected by? We have mentioned the taxes collected by each tiers of government. So, ladies and gentlemen, this introduction to tax I'm doing is a 22 pages. I'm giving you guarantee. I'm not saying it. It's based on experience. I've been lecturing this task for the last 7 years, and I've qualified 14 years ago based on experience. Introduction to tax for your syllabus, for your exam, carried 15-mark question. So these 22 pages, at least 15-mark question is coming from this area. Let's take note. You can be asked, what are the taxes collected by each tier of government? Let's know 5. You can be asked, what are the objectives of taxation? Let's know at least 5. You can be asked, what are the principles of taxation? Let's know at least 5. Challenges of taxation. What are the challenges that we experience while collecting tax? Challenges of taxation. Number 1 challenges of taxation we have is poor tax administration. Poor tax administration. The tax administration, the tax authority, they are not doing their job very well. They are not doing their job very well. They don't administer tax very well. They are not doing their job efficiently. It's giving tax a problem. You understand? Another one, multiplicity of tax. Multiple tax. It's a challenge of tax. Multiple tax simply means we have different type of taxes collected by one single income. You earn 100,000 naira or you earn 500,000 naira. Out of that 500,000, you pay value added tax, you pay personal income tax, you pay stamp duty, you pay local government due on the same 500. That is multiple taxes. Multiple taxes arise where different taxes by each tier of government is leveled on the same income received by one single individual. It's a problem of taxation. One income, government collect like 5 different taxes. That is multiple tax. It's a problem to taxation. Another one is lack of accountability of tax revenue. Government cannot they cannot be accountable for the revenue that they collected through tax. So they can't account for the tax revenue that they collected. It's a tax challenge. Another tax challenges that we have, lack of public enlightenment. Tax authority, they are not doing enlightenment they are not enlightening the public on the importance of tax. Why does public need to pay tax? What are the importance of tax? What are the consequences of not paying tax? They are not sensitizing. They didn't do enough sensitization on taxation. Another problem of taxation is high level of corruption. High level of corruption. Tax officials, they are human beings. They are not coming from the heaven. They are in Nigeria. They are drinking from Nigeria water. Do you understand my point?
Yeah.
They are driving on the road. So they are eating Nigeria food. When you are drinking Nigeria water, you are driving down the road, you are eating Nigeria food. Do you understand what I mean? Do you understand that?
Yes, sir.
So they are bound to do otherwise. In the long run, tax authority, they collide with who? Taxpayers to reduce tax to taxpayer. They are human beings too. They need to do something. They need to provide for their basic needs. So they are somehow corrupt. So it's a problem that they will reduce the tax that tax authorities, taxpayers are supposed to pay. They will reduce it for the taxpayer. They will receive bribe for that. That is loss of revenue for government. It's a problem to tax system. Over dependence on oil revenue. For the last 5 years ago, Nigeria government revenue, 60% of it is coming from oil. We have depend too much on oil, petroleum profit tax, royalty, sales of crude oil. We have depend too much on it. We have, for other sources of revenue, we don't put too much of effort on them. But as I'm talking to you right now, there is a paradigm shift from oil revenue to non-oil revenue. Government now, because of crash in the price of crude oil, the eyes of the Nigeria government now is now open to non-oil revenue. They are now introducing new form of tax in terms of non-oil revenue. Example of that, electronic development levy was introduced. VAT was increased to 7.5% from 5%. Do you understand? So they are now introducing a non-oil revenue. There's another one that was just introduced. We call it cyber crime levy. Abi? You have heard of cyber crime levy?
Yes.
There's another tax that FRSA bank must be paying on their foreign exchange gain. That tax is called what? Who can tell me? We call it windfall tax. It was reduced this year. They said they must pay it on their foreign exchange. Windfall tax. So those are the problem of taxation that we have. So please, ladies and gentlemen, let's know at least 7 problems of taxation. Let's know at least 7 problems of taxation. Let's know that. So we have talked about the next area that we will go is concept of tax identification number, tax clearance certificate. Concept of tax identification number, tax clearance certificate. So please, let's go for a break of 10 minutes. I need to do something. We will now move to this concept of tax identification number and tax clearance certificate. Hello? Hello? Can you hear me now? Hello?
You can hear you, sir.
Okay, we are back to the class. Concept of tax identification number. What is tax identification number? Tax identification number is a unique number allocated to the taxpayer by the tax authority for the purpose of identification of the taxpayer. A unique number is normally a 9-digit number that is allocated to the taxpayer by the tax authority for the purpose of identification during tax return or payment of tax. As a company, if you want to pay tax, you use your TIN number to pay. As an individual, if they want to pay tax, if your employer want to pay tax for you, they use your taxpayer ID to pay for you, so that the tax will be credited to your account. So a unique number that is given by the tax authority to taxpayer for the purpose of identification during tax return and tax payment, it is called tax identification number. Within 6 months from the date of commencement of a business, a company is required to register for tax. When a company registers for tax authority will issue him a letter. That letter will contain his tax identification number. Objective of tax identification number. Why do you give tax identification number? Why does the tax authority give tax identification number? To create a closer linkage between tax authority in Nigeria. To create a closer linkage between tax authority in Nigeria. Another one, to aid cooperation and information sharing among tax authority. To aid cooperation and information sharing among tax authority. To increase revenue generation to all tiers of government. Objective of TIN, to increase revenue generation to all tiers of government. Now, what are the requirements for TIN registration? If you want to register for TIN as a company, if your company want to register for TIN, what are the requirements for TIN registration? Requirement for TIN registration. You want to register your company TIN with FRS. The requirements include the name of the company, the registered address of the company, the type of business the company engaged in, the copy of certificate of incorporation, certified copy of memorandum and article of association, the name and address of the director, the name and address of the company's external auditor and tax representative, the name and address of the company secretary, the proposed accounting year end of the company. All these are the requirements for TIN registration. What are those transactions that TIN number will be required. What are those transactions if you want to do that they will ask for your TIN number? They will ask you, show me your TIN number. Number one, open of corporate bank account. You want to open corporate bank account with commercial bank. Your company want to open bank account. They will ask for your TIN number. Number next, transaction relating to invoices or statement and return. Another one, transaction relating to ministry or government. You want to bid for government contract or you want to supply good to government. They will ask for your TIN number. Importation of good. If a company import good, that company want to pay custom duty, they will ask for the TIN number. Tax clearance certificate. You will collect tax clearance certificate with FRS or State Board of Internal Revenue. They will ask for your TIN number. Obtaining receipt for tax payment. They will ask for your TIN number. So all these are the transactions that will be that TIN number will be needed for. What are those? So please, let's know at least 7 transactions that TIN number will be needed for. Another concept we need to look at is called tax clearance certificate. Tax what? Tax clearance certificate. What do we understand by tax clearance certificate? Tax clearance certificate is a document or certificate issued by the relevant tax authority, which can either be FRS or State Board of Internal Revenue. A document or certificate issued by relevant tax authority to the taxpayer, serving as an evidence that all tax obligations have been complied with. Serving as an evidence that all tax obligations have been complied with. It's a tax clearance certificate. They will give you. When the tax authority certifies that you have paid all the relevant tax that you need to pay, that you are not owing any tax, that you are a good taxpayer, you normally pay tax at when due. That certificate that they will give as a recommendation letter that this person, you can do business with him, is called tax clearance certificate. What are the contents of tax clearance certificate? What are the contents of tax clearance certificate? Number one content of tax clearance certificate is the name and address of the company that applied for that tax clearance certificate. The name and address of the company that apply for the tax clearance certificate. Number two is the tax payable, the tax identification number of the company. TIN number, that thing that we explained earlier, for that company that applied for the tax clearance certificate, they will ask for it. TIN number of the company that applied for the tax clearance certificate. Another one, the total profit or chargeable income of the company or individual. The tax payable for the last 3 years. The tax paid for the last 3 years. Tax outstanding for the last 3 years for the company that applied for the tax clearance classification. The nature of the business. The type of the assessment. The expiring date of that tax clearance certificate will also be needed. The expiring date of the tax clearance certificate. The name and designation of the official approving the tax clearance certificate. Which official of the tax authority approve the tax clearance certificate? For FRS, it is the tax controller, head of a tax station, that will approve the tax clearance certificate. But for states, it is the tax manager, station manager, that will approve the tax clearance certificate. So these are the contents of tax clearance certificate. What are those transactions that will be that tax clearance certificate will be required? What are those transactions that tax clearance certificate will be required? Number one, application for approval of building plan. You want to build house in Lagos, especially in VI or Lekki, you want to build 3-story building. You cannot start building without a building plan. You have to collect a building plan from the state government. If a state government, Lagos State, want to give you a building plan, they will ask you, Oga, you want to build an house, a building that worth 200 billion, a building that worth 500 million. Go and bring your tax clearance certificate. Let's look at the amount of tax you are paying. They will ask for your tax clearance certificate. Application for firearms license. You want to collect gun, firearms. You want to apply for license for gun. They will ask for your tax clearance certificate. Application for government loan. You want to apply for government loan, like government loan in Bank of Industry. They will ask for your tax clearance certificate. Application for award of government contract. You want to bid for government contract. You want government to give you a contract. They will ask for your tax clearance certificate. Application for certificate of occupancy. You want to collect C of O for your land. They will ask for your tax clearance certificate. Application for market store. You want to collect a market store, market built by government. You want to buy it. They will ask for your tax clearance certificate. Application for motor vehicle license or vehicle ownership. They will ask for your tax clearance certificate. Application for increase in share capital as a company. A company want to apply for increase in their share capital. They will ask for their tax clearance certificate. Application for distributorship. They will ask for your tax clearance certificate. All this will be required. Tax clearance certificate. Application for agency license. Your tax clearance certificate will be asked. So they'll ask for your tax clearance certificate. So those are the transactions. This transaction I mentioned is applicable to both company and individual. However, there is one that is applicable to individual direct. If individual want to collect tax clearance certificate, what are those transactions that you want to do that they will ask as an individual? They will ask, go and bring your tax clearance certificate. You want to pay school fees payment. Maybe your children, when your children is in public university or public secondary school, you want to pay school fees, they will ask for tax clearance certificate. You want to scan school fees for your children in abroad. You want to buy foreign currency, they will ask for your tax clearance certificate. You want to pay payment of upkeeping for your children in abroad, they will ask for tax clearance certificate. Personal traveling allowance. You want to travel and you need foreign currency for the allowance, they ask for your tax clearance certificate. Business travel allowance, you are going for business trip, you need from foreign currency, they'll ask for your tax clearance certificate. So please, ladies and gentlemen, try to differentiate between tax clearance certificates, TCC, and TIN number, tax identification number. They are different. The transaction in which TIN number will be needed is different from the one tax clearance certificate will be needed, though they are somehow interwoven. TIN number means number that will be given to a taxpayer as an evidence that that taxpayer has registered for tax. As an evidence, a unique number issued to taxpayer by the tax authority as an evidence of tax registration. That is TIN number. The tax clearance certificate means a document given to the tax payer by the tax authority certifying that all tax obligation for the relevant year, usually 3 years, have been complied with. That is tax clearance certificates. So, ladies and gentlemen, this is where we need to stop. Any question, any issue on this topic, introduction to taxation? Any question, any issue?
No questions, sir.
So in the absence of no question, we can call it a day. So please,
I have a
once
question.
again, okay,
So
go
you
ahead.
mentioned that for the personal income tax, that according to the table that you sent, that you showed us, that is from 300,000.
Yes.
So what about people that are earning less than 300,000? How is that going to be applicable? I heard you mention.
Okay, continue.
So I heard you mention 7%. So I don't know where that is applicable to.
If your chargeable income is less than 300,000, that means, assuming your chargeable income is 200,000, that means your personal income tax will be 7% of 200,000. Because we said first 300,000. That does not mean it must be 300,000. It may be less than 300,000. Any income less than 300,000, the personal income tax rate will be 7%. 7%. Any income less than 300,000. That means that income fall within this place. It fall under first 300,000. However, Finance Act 2019 said any taxpayer, any employee, any minimum wage or below, somebody any minimum wage or below is exempted from paying personal income tax. What is minimum wage? If your gross income in a year is 30,000 per month times 12, 350 in a year. If your gross income in a year is 360,000, you will not pay personal income tax because your gross income is minimum wage or below. That is gross income. It is not chargeable income. We are still coming to a topic under personal income that we explain in details how we compute personal income. By that time, you will understand more on personal income tax rates. Any other question?
No, sir.
Yes.
So what's our next topic?
Our next topic, which we are going to do, will be based on stamp duties and multiple taxation. Those are the two written. After those two written, all the other one we'll be doing will be calculation. After stamp duties and multiple tax, we are going to do them together. After that one, we are now going to do personal income tax. So I'm praying by during this week, if you have any free lecture period, please let me know.
I'm not sure if we have within the week. There's no free lectures, or except I don't know.
Tomorrow we cannot fix lecture on Sunday from 8 to 9. So that we do stamp duties and multiple tax. They are short topic, they are written. We just do them within 1 hour, 1 minute, we are done. 1 hour, 30 minutes. Yes. Can we fix lecture tomorrow?
Let's do it tomorrow.
Okay, please. Let's take the sacrifice. I pray by God's grace, by God's grace, inshallah, we come out in fly color.
Amen. No. Yeah. So what time tomorrow?
From 8:30 or 9 o'clock. From 8:30 to 9:30.
8:30. Is it AM, PM?
I'm having lecture in the morning. I will be free from 8:30.
Okay, 8:30 PM.
Yes.
Okay.
So please, let's take the sacrifice. God will crown our effort by God's grace.
Amen.
Okay. Thank you.
Thank you, sir.
Yes. Have a nice day.
Yes, sir.